Your credit score. Chapter 1. Your credit score determines how much money you can borrow. Biggest downside of bad credit score. If you have a bad credit score, you might not be able to get a loan at all, including a mortgage. If you do get a mortgage, the interest rate is considerably higher than someone with a good credit score. If you do the math, you'll see that over the life of the mortgage, you end up paying a lot more money than the other guy. nfcc.org. The Credit Scoring System 1. Creditors approve credit to those people who most closely match the right profile. They arrive at those conclusions by assigning point values to various items of information that are included either on your credit application or in a credit report. The credit bureaus need a pseudoscientific way to calculate the credit worthiness or risk of people in an objective way. Each of the three main credit bureaus has formulated a credit scoring system that are basically alike with subtle differences. Get your credit score, myfico.com. Your FICO score is a number between the 500 and 850. The higher it is, the better your credit worthiness. There are 7 FICO ranges. 720 to 850. 700 to 719. 675 to 699. 620 to 674. 560 to 619. 500 to 559. Below 499. Beyond the raw score, there is a letter grading score as well. Each lender has different rules about which people they lend to based on score. As follows. A grade, 640 or higher. You have either perfect credit or maybe just one small, minor transgression. B grade, 580 to 640. A few minor glitches but overall solid. C grade, 500 to 580. You're alright about half of the time. The problem is paying your bills late. D grade, below 500. You're a risk. Some lenders accept only A borrowers, whereas others specialize in C and even D customers and offer them a loan at a high interest rate. Some C and D borrowers have legitimate reasons for their current low credit rating. They may have lost their job, have unexpected big bills like a medical illness, maybe your business went bust, maybe your mother died and you paid for her funeral, maybe you're the victim of identity theft or have a shopping-addicted wife. Others make a good living but spend money as fast as it comes in and seem to realize that creditors don't like a fast or feast attitude in credit reports. People who often make good money but don't know how to manage it, spending it on useless things they don't really need, putting themselves into debt for them. The higher the category you can get your FICO score means the better your chance of getting credit and also the better interest rate you get on loans and credit cards. This is very important. I've seen a 4% difference on a mortgage loan for a credit score in the lowest and highest category. I've seen a 10-point difference for a car loan. Do whatever you can to get the FICO high before you apply for a mortgage to save lots of money on a lower interest rate. The less credit you use relative to the credit limits you have, the higher your FICO. Several different factors make up the credit score. The most important one is past track record in paying bills on time. This makes up about 35% of your FICO. Debt to credit limit ratio. How much money/credit do you have out relative to your credit limit? How much of your total credit limit are you actually using right now? The lower this ratio is, the more unused credit you have, hence the better your FICO. Don't use your credit even though it's there if you don't have to in order to increase your FICO score. This makes up 30% of your FICO. Credit history is good, so if you have a credit card that you have paid faithfully on for a long time, canceling it would wipe out that part of your credit history. Consider keeping it and canceling your newer cards. This makes up about 15% of your FICO. The last 20% is determined by how many credit cards and loans you have and how many ones you applied for recently. Creditors are looking for a good balance of type of credit cards, a few general ones, a gas credit card, a retail credit card, but they don't want to see a lot of credit cards. Recent credit card applications indicates a kind of desperation to them. In order to get a good FICO score, you need at least one credit card that you pay regularly on. Even if you don't need the credit, if you want to build a high FICO, make one purchase for $20 per month, then pay it off immediately. This will help you greatly with a lower interest rate when you want to get a mortgage loan. Cancel your newest cards, not the old ones. If your old card has a high interest rate, keep it but don't use it for a while. Use a newer one with lower interest. Whenever you apply for credit anywhere, they make a request for your FICO. The credit reporting agencies interpret that as you looking for a new source of credit, so too many requests lowers your score. The bad thing about this is that if you are applying more a mortgage and you apply to 10 mortgage companies, all those requests for your credit score could make you look bad, so the credit card reporting companies say they realize this, so if you do it all in a 2-week period, it will just be counted as one request for your credit score and your credit score will not be hurt. If you have a spouse with a bad FICO and you have a good one, apply for loans using only you as the applicant, not the spouse. Young people can build up a good FICO by piggybacking on their parents' good credit. Add them as authorized users on your credit cards, and as long as your credit is good, they will build up a good credit record. This works in reverse too. If your parents have bad credit, separate your credit from theirs. The most important things to do to keep a high credit score are as follows. Pay your bills on time. Keep low balances, what you owe beyond the minimal payment required, on credit cards and other revolving credit accounts. Do not go near your credit limits. Stay far below them. Don't get a lot of the same type of credit cards, only one of each from the big 4 credit card companies, then one gas card, and 1 or 2 department store cards, and that's it. Too many cards lowers your credit score. The credit scoring system too. A lending institution uses a credit score to determine 2 things. Whether to extend to you credit. What interest rate they will charge you. The lower your credit score, the more risk you are, therefore the higher the interest rate. Your credit score makes a big difference on the interest rate, particularly on a mortgage, which is a major chunk of change. Credit card companies like scoring systems because as a large volume creditor, they can replace trained credit personnel with a relatively few employees who can quickly total number columns and determine if an applicant's point values add up to the right score. In general, the credit grades they categorize people into are as follows. R0 is when they give new people a chance to see which they will go, like college students. To make a customer for life by giving them a bit of good faith up front, credit generally outweighs the losses they accrue by granting credit cards to college students en masse. R1 is the person with the best credit rating, R9 is the worst. R0, too new to rate, approved but not yet used. R1, pays within 30 days, all payments up to date. R2, pays within 30 to 60 days and is not more than 1 payment behind. R3, pays in 60 days to 90 days or is 2 payments behind. R4, pays in 90 to 120 days or 3 or more payments behind. R5, account at least 120 days overdue but not in collection. R6, no R6 category. R7, making regular payments under consolidation agreement or other similar type agreement. R8, in repossession. R9, account is in collection mode by bill collector or debtor can't be found. Scoring is done for one reason. A creditor just wants to know that the odds are high he will get his money back. Scoring systems are fine for those people who fit right into the right profile, but what about those who don't but could pay off their monthly obligations just as easily and reliably as the next person? If you are one of those people who doesn't fit the mold, you will simply have to make a few adjustments in your application so that you do fit the scoring profile of what a creditor is looking for in a final total. The first thing you should know is that every system is different. That in itself can work to your advantage. You could be rejected by one company's scoring system and approved by another. One creditor's system will give you many points for a good answer and totally ignore a question that gives a negative answer. Another creditor can simply reverse the process. Some rely strictly on their own instinct and experience. Others use a credit scoring or statistical system to predict whether you're a good credit risk. They assign a certain number of points to each of the various characteristics that have proved to be reliable signs that a borrower will repay. Then they rate you on this scale, and so, different creditors may reach different conclusions based on the same set of facts. One may find you an acceptable risk, while another may deny you a loan. In general, creditors look for an ability to repay debt, a willingness to do so, and sometimes for a little extra security to protect their loans. When you're ready to apply for credit, you should know what creditors think is important in deciding whether you're creditworthy. You should also know what they cannot legally consider in their decisions. The Equal Credit Opportunity Act requires that all credit applicants be considered on the basis of their actual qualifications for credit and not be turned away because of certain personal characteristics. They look for the 5 C's: capacity, character, collateral, credit, capital. Capacity. Can you repay the debt? Creditors ask for employment information, your occupation, how long you have worked and how much you earn. They also want to know your expenses, how many dependents you have, whether you pay alimony or child support, and the amount of your other obligations. Character. Will you repay the debt? Creditors will look at your credit history, how much you owe, how often you borrow, whether you pay bills on time, and whether you live within your means. They also look for signs of stability, how long you have lived at your present address, whether you own or rent, and length of your present employment. Collateral. Is the creditor fully protected if you fail to repay? Creditors want to know what you may have that could be used to back up or secure your loan, and what sources you have for repaying debt other than income, such as savings, investments, or property. Creditors use different combinations of these facts in reaching their decisions. Some set unusually high standards and others simply do not make certain kinds of loans. Creditors also use different kinds of rating systems. Some rely strictly on their own instinct and experience. Others use a credit scoring or statistical system to predict whether you're a good credit risk. They assign a certain number of points to each of the various characteristics that have proved to be reliable signs that a borrower will repay. Then they rate you on this scale, so different creditors may reach different conclusions based on the same set of facts. One may find you an acceptable risk while another may deny you a loan. The general things they look for are: purpose of the loan. How much do you owe now? Total debt service ratio /TDS. Your past payment of debt. Your employment history. How long have you lived at the same residence? Stability. How much money do you make? How stable is your job/business? What are your family responsibilities, other obligations? Keeping in mind that creditors use different scoring systems. The following categories are listed from the highest to lowest points awarded. Each responds to basic questions on a credit application form. Credit record. Your credit record lists anyone with whom you have had credit dealings. The longer your credit has been extended and the larger amount you have been allowed to charge, the better your credit rating will be. Residence. The longer you have lived in one place, the better. Stability is given high points. Home ownership. The best possible housing situation is to own your own home, even if it is mortgaged. The worst is renting an unfurnished apartment, living with parents, living in a trailer or motel. Geographic location. Scoring systems are adjusted for differences in geographic locations. There are areas where there is a high incidence of credit problems, reoccurring employee/employer differences, low income, etc. Employment. The longer you have been on a job, the better. Occupation. Occupations can be divided into many categories with a high to low score within each category for different occupations. Age. Older is not considered better until you pass age 40. Under 25 to the end of your 30s receive the lowest scores. The rationale is that people under 25 haven't proven they are a good credit risk. People in their 30s are still raising a family, buying a home, and tied down with enormous expenses. This is also the time most people declare bankruptcy. Income. The higher your income, the more points you will receive. Telephone. Having a telephone is an indication of stability. Age of automobile. No auto is a low score, but the newer the vehicle the higher the score. Dependence point 1 to 3 indicates responsibility and stability. After 3, points drop rapidly. Citizenship status. Non-citizens receive negative points. Bank accounts. You receive high points if you have a checking and savings account. Credit references in-house records. A good payment record will earn you more points. Credit cards. The more major credit cards you have, the better. Bank loans. A current bank loan will increase your score. Finance company loans. You will receive negative points for each finance company loan. Expenses and debts. The more expenses, the lower your rating. A loan officer looks at how much money you have left after you meet your monthly expenses. He looks for a low income to expenses ratio. Down payment. If you want to buy something on credit, the larger the down payment you offer, the better your chances of success. The more you put down, the lower risk you are to the lender. The higher your credit score, the better rates you get on credit cards and loans. The more of a credit history you have, meaning the more credit cards and loans you have, provided you pay on them, the higher your credit score. Balance determination methods. Creditors must tell you the method they use to figure the balance on which you pay a finance charge. The interest rate they charge is applied to this balance to come up with the finance charge. Creditors use a number of different methods to arrive at the balance. Study them carefully, they can significantly affect your finance charge. Some creditors take the amount you owed at the beginning of the billing cycle and subtract any payments you made during that cycle. Purchases are not counted. This is called the adjusted balance method. Another is the previous balance method. Creditors simply use the amount owed at the beginning of the billing cycle to come up with the finance charge. Under one of the most common methods, the average daily balance method, creditors add your balances for each day in the billing cycle and then divide that total by the number of days in the cycle. Payments made during the cycle are subtracted in arriving at the daily amounts and, depending on the plan, new purchases may or may not be included. Under another method, the two-cycle average daily balance method, creditors use the average daily balances for 2 billing cycles to compute your finance charge. Again, payments will be taken into account in figuring the balances, but new purchases may or may not be included. The amount of the finance charge may vary considerably depending on the method used, even for the same pattern of purchases and payments. FICO score/Fair Isaac Corporation score. FICO means the Fair Isaac Corporation score system. It goes from 300 to 850. The higher your score, the better. The lowest interest rate you'll get on loans. If your score is under 700, that's not so good. Your FICO score is made up of 5 factors. Payment history, 35%. Amount of current debt, 30%. Length of credit history, 15%. Amount of new credit, new loans, 10%. Types of credit, how many different credit loans, 10%. Your FICO score is a number between the 300 and 850. The higher it is, the better your credit worthiness. There are 7 FICO ranges. 720 to 850. 700 to 719. 675 to 699. 620 to 674. 560 to 619. 500 to 559. Below 499. Beyond the raw score, there is a letter grading score as well. Each lender has different rules about which people they lend to based on score. As follows. A grade, 640 or higher. You have either perfect credit or maybe just one small, minor transgression. B grade, 580 to 640. A few minor glitches but overall solid. C grade, 500 to 580. You're alright about half of the time. The problem is paying your bills late. D grade, below 500. You're a risk. Some lenders accept only a borrowers, whereas others specialize in C and even D customers and offer them a loan at a high interest rate. Some C and D borrowers have legitimate reasons for their current low credit rating. They may have lost their job, have unexpected big bills like a medical illness, maybe your business went bust, maybe your mother died and you paid for her funeral, maybe you're the victim of identity theft or have a shopping-addicted wife. Get your credit score, myfico.com. Improve FICO score. Red flags that credit companies look for are transient lifestyle, moving a lot, changing jobs a lot, late and missing payments, almost no credit history. You need debt for them to see how you've handled it. Too many loans and credit cards. Too much credit. Lots of credit inquiries, it means you're looking for more credit, possibly to get what you can then walk away. Positive things creditors like are: pay more than the minimum on your credit card. Credit companies are afraid that you're near bankruptcy if you just pay the minimum. Pay your bills on time. Keep what you owe low. Have a good credit history. Don't have too many credit cards and loans out. Don't consolidate your loans. Not a recent flurry of credit card buying. Paying off debts in full. Never go over your credit limit. If you need a higher credit score, don't close down credit cards because it reduces your credit limit, therefore increases your debt ratio. The best thing to do is destroy the card, but don't close it down with the company. Once your credit score hits 700, start closing down your cards. Overall, lenders give higher marks on a credit score for the following conditions: own rather than rent a home. Have been at their current jobs for at least 2 years. Work for someone else rather than being self-employed. Lived at present address for several years. The higher the salary, the better. The Vantage Credit Score. The Vantage score was created by a joint effort between Experian, Equifax, and TransUnion. It goes between 501 to 990. A. 901 to 990. B. 801 to 900. C. 701 to 800. D. 601 to 700. F. 501 to 600. VantageScore.com. CreditReporting.com/VantageScore.html. CreditScoreAvantage.com. VantageScore.Experian.com. VantageScoreFacts.com. YOURFICO-SCORE.com. Many employers look at your credit score. Many employers in any business that deals with money look at prospective employees' credit ratings to see how good or honest you are in handling money. Employers in other fields look at your credit score too. FICO websites. There are many credit scores out there, but the majority of lenders use your 3 FICO scores based on your credit reports. myfico.com. aficoscore.com. creditscorequick.com, free. creditscoring.com/creditscore/FICO. Fairisaac.com, credit scoring system. Fairisaac.com/Fairisaac, 415-472-2211. FICOscorescene.com. FreeCreditsBureauReports.com. InstantCreditCard.com. Investopedia.com/term/f/FICOscore.asp. myfico.com. Credit score websites. Credit scores predict how likely you are to make your credit payments on time or at all. CreditScoreReview.net. ftc.gov/bcp/edu/pub/consumer/credit/cre24.shtm, credit scoring fact sheet. CreditReportHelp.net. thecreditscore.com. experian-creditReport.com. en.wikipedia.org/wiki/credit_score. en.wikipedia.org/wiki/credit_scorecards. en.wikipedia.org/wiki/credit_score_left (United_States right). yourfico-score.com. FreeCreditsBureauReports.com. creditscoring.org, eloan.com, myfico.com, see your credit score.